Microsoft just did something on Wall Street that has not happened in almost 18 years. And if you are an investor, especially anyone holding tech stocks or thinking about AI exposure in your portfolio, you need to understand exactly what happened, because this is not just another earnings report. This is a moment that is already reshaping how the entire market thinks about artificial intelligence spending. On July 29, 2026, Microsoft reported its fiscal fourth quarter results, and the very next day, the stock surged by roughly 15%, its biggest single-day jump in almost 2 decades.
To put that in perspective, Microsoft is one of the largest companies on planet Earth, worth well over $3 trillion. And a move like this in a single day for a company that size is almost unheard of. When a company this massive moves this fast, it does not just affect Microsoft shareholders. It sends a signal through the entire artificial intelligence sector. And today, I am going to break down exactly what happened, why it happened, and most importantly, what it actually means for you as an investor going forward.
Let's rewind for just a second, because you need the full picture to understand why this moment mattered so much. For most of 2026, Microsoft stock had actually been struggling. Heading into this earnings report, the stock was down close to 20% for the year, while several of its Magnificent Seven peers had already recovered from earlier sell-offs. Investors had grown nervous, and here is exactly why. Microsoft had committed to spending around $190 billion in capital expenditures for the year, pouring money into data centers, networking hardware, and AI chips at a scale most companies could never dream of attempting. Wall Street kept asking the same uncomfortable question over and over. Is all of this AI spending actually turning into real profit, or is Microsoft simply burning enormous amounts of cash chasing a technology trend that may not pay off the way everyone hopes? That fear was not unique to Microsoft either. Other major technology companies reporting heavy AI capital expenditures had already experienced serious stock sell-offs earlier this year, and investors were bracing for Microsoft to follow that same painful pattern. Then the earnings came out, and the picture completely flipped. Microsoft reported revenue of $90 billion for the quarter, which was an 18% increase year over year, and it beat what analysts on Wall Street were expecting. But the number that truly stole the show was Azure, Microsoft's cloud computing division, which is the primary engine powering its artificial intelligence business. Azure grew somewhere between 40 and 43%, depending on how you measure it, and that is an enormous growth rate for a business already generating tens of billions of dollars in revenue. Microsoft's commercial backlog, essentially contracts and commitments that customers have already signed but have not yet been billed for, jumped to $627 billion, nearly doubling year over year. Think about what that number really means. That is over $500 billion of future business that companies have already agreed to pay Microsoft for artificial intelligence and cloud services, sitting on the books waiting to be delivered. That is not hype. That is not speculation. That is contracted, committed revenue. But here is the piece that really sent the stock into overdrive. And this is the part most casual investors completely missed. Alongside these strong numbers, Microsoft told investors that its massive capital expenditure spending would hold roughly steady rather than spiraling even higher, and that the company expected to keep generating strong cash flow all the way through its new fiscal year. For months, the entire market had been terrified that AI spending was becoming a bottomless pit with no end in sight. Microsoft essentially stood up in front of Wall Street and said, "We're still spending an enormous amount of money, but we now have a credible path where this spending stabilizes while the revenue from it keeps accelerating." That combination, faster growth alongside more disciplined and predictable spending, is exactly what nervous investors had been begging every AI company to prove, and Microsoft was the first of the giant technology companies to actually deliver it convincingly. Goldman Sachs analysts specifically pointed to this as a turning point, noting that Microsoft was finally showing Wall Street multiple credible paths to turn its AI investment into real, tangible revenue, rather than just a story about potential. Now let's talk about the OpenAI piece of this puzzle, because you cannot fully understand Microsoft's AI position without understanding this relationship, and it has changed dramatically this year. Back in October of 2025, OpenAI restructured into a public benefit corporation. And as part of that restructuring, Microsoft ended up holding an investment in OpenAI valued at roughly $135 billion, representing about 27% of OpenAI on an as-converted basis. Then, in April of 2026, the two companies rewrote major parts of their partnership. Microsoft's exclusive lock on selling OpenAI's technology ended. OpenAI became free to run its products on other cloud providers, including a massive expanded partnership with Amazon Web Services.
In exchange, Microsoft stopped paying revenue share on OpenAI products it resells, and OpenAI's revenue share payments back to Microsoft were capped moving forward. Here is why this actually matters for you as an investor. Microsoft no longer needs exclusive access to OpenAI to profit from the artificial intelligence boom. It still holds a massive equity stake worth well over $100 billion. It still remains OpenAI's primary cloud partner, and now it also has the freedom to pursue artificial intelligence independently, including its own models and a diversified set of partnerships. Microsoft has quietly become less dependent on any single AI partner while still keeping a huge financial stake in the most talked about AI company on the planet. That is a much stronger, more diversified position than most investors realized.
So why does the headline say Microsoft changed the entire AI stock market forever? Here is the mechanism. And this is the part that connects Microsoft's earnings to every other stock in your portfolio. Microsoft is what is called a bellwether for the entire artificial intelligence infrastructure trade. When Microsoft reports and the market sees genuine proof that heavy AI capital spending is translating into real accelerating revenue, with capital expenditures leveling off rather than spiraling out of control, it does not just lift Microsoft stock, it reduces fear across the entire sector. Investors have been terrified that we were living through an AI spending bubble, where trillions of dollars were being poured into data centers and chips with no clear path to profit. Microsoft's results, combined with its steady capital expenditure guidance, gave the market real evidence against that bubble narrative, at least for now. That is precisely why broader stock indexes moved higher the day after Microsoft reported, and why other AI-related companies, from chip makers to other cloud providers, felt the ripple effect. When the largest, most scrutinized AI spender on Earth says the spending is starting to pay off in a measurable, provable way, it gives permission for the entire market to breathe a little easier about the artificial intelligence trade as a whole. Now, before you get swept up in the excitement, let's talk honestly about the risks, because a responsible investor never ignores the other side of the story. First, one incredible earnings report does not erase the underlying tension that still exists. Microsoft is still spending on a scale most companies could never survive, close to $190 billion a year, and that number could rise again in future quarters depending on demand for computing capacity. If Azure growth ever decelerates meaningfully, say back into the 30% range instead of holding near 40%, or if that $627 billion backlog stops growing at the pace investors expect, the market could reverse its optimism just as quickly as it embraced it. Second, remember that even after this massive one-day surge, Microsoft stock was still recovering from being down significantly earlier in the year. A huge single-day jump after a beaten-down stretch is not the same thing as a company that has been steadily climbing for months. Third, competition in this space is fierce and evolving quickly. Amazon, Google, and a long list of other companies are all racing for the same enterprise artificial intelligence spending, and OpenAI itself is no longer exclusively tied to Microsoft's infrastructure. Diversification cuts both ways. It reduces Microsoft's dependency risk, but it also means Microsoft now has to compete harder to keep OpenAI's business rather than simply owning it by contract. So what should you, as an investor, actually take away from all of this? First, understand that this earnings report is a genuine signal, not just noise. That at least one of the largest artificial intelligence spenders in the world is starting to show real, measurable proof that the spending can convert into durable revenue growth. That matters for how you think about the broader AI theme in your portfolio, not just for Microsoft specifically. Second, do not chase a stock purely because of a single dramatic headline or a 15% single-day pop. Chasing a stock right after a massive spike is one of the most common mistakes investors make, buying euphoria at the top rather than value at a reasonable price. If you are interested in Microsoft or the broader AI infrastructure theme, the smarter move is to study the actual trend over the next 2 to 3 quarters. Watch specifically whether Azure growth holds steady near that 40% level, whether that commercial backlog of $627 billion keeps expanding, and whether capital expenditures truly stay disciplined the way management promised, rather than quietly creeping higher again. Third, remember diversification is still your best protection. Even a company as dominant as Microsoft carries real risk, competitive pressure, valuation risk, and execution risk. If artificial intelligence exposure is something you want in your portfolio, spreading that exposure across multiple companies or through a broad technology-focused fund protects you from becoming overly dependent on any single company's next earnings report, including Microsoft's. Here is the bigger picture I want you to walk away with today. For most of this year, the entire artificial intelligence trade was operating on a foundation of hope and forward-looking promises.
Microsoft's latest earnings report was one of the first times a truly massive AI spender put hard, verifiable numbers on the table. $90 billion in quarterly revenue, Azure growth near 40%, a backlog approaching $630 billion, and a credible plan to stabilize spending while growth accelerates. That is the difference between a story and evidence. And evidence is exactly what moves markets the most violently, in either direction. Whether this marks the true turning point for the entire artificial intelligence sector or simply one strong quarter inside a longer, bumpier story is something only the next few earnings seasons will reveal. Your job as an investor is not to predict the next single-day headline. It is to watch the actual trend, stay diversified, and make decisions based on evidence rather than excitement. If this breakdown helped you understand what actually happened behind the headlines, stay close because we are going to keep tracking these earnings seasons together, and I do not want you to miss the next one.